Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 148, this is a subject that I was really excited to do the math behind and do some of the modeling related to. Although very simplified, we're going to walk through some mathematical examples which show how you can reduce your estate tax counterintuitively by paying lifetime gift and income taxes out of pocket, and how you can leverage different strategies to arrive at the estate tax savings that we're going to talk about. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, when it comes to the estate tax, right now, it kicks in when the combination of your gross estate minus deductions and your lifetime taxable gifts combined exceed the estate tax exclusion of $11.7 million, and the rate is 40% on the amount over and above that. So, traditionally, you could reduce the effect of the estate tax by transferring away assets during life. But in order to do so, really what you'd be doing is removing future appreciation from your gross estate, because in the estate tax calculation, you still take into account the value of your lifetime taxable gifts. Now, it's seeming like a reduction of the exclusion, it would be inevitable given the conditions and makeup of Congress right now. And the lower the exclusion, the higher your potential for estate and gift tax. It's rare that gift tax is ever paid out of pocket anymore because we have such a huge $11.7 million exclusion that you only dip into if you exceed your annual exclusion of $15,000 per donee per year for present interest gifts. But there's a key difference between the gift and estate tax that we'll see, as well as a difference that applies when we use grantor trusts. And it's going to seem like one would work out better than the other, but what we're going to see is that's not always the case, depending on which strategy you use and how you net out the taxes that you pay during life versus the taxes you save at death. Now, one big difference that makes this possible is the fact that the gift tax is tax exclusive, meaning that the gift is not reduced by the gift tax. So anytime you make a gift and you pay gift tax out of pocket, you're reducing the size of your estate by not only the value of the gift, but also the amount of the gift tax you've paid. Contrast that with the estate tax, which is tax inclusive, which means that the estate is reduced by the estate tax itself. Now, that's only relevant, really, in the grand scheme of things when gift tax is paid out of pocket. But that might become a more frequent occurrence depending on the outcome of tax changes that might take place this year or next year, or any time in the future. And that scares a lot of people, but what we're going to see is that payment of gift tax out of pocket may have some hidden benefits. So to start with, we're going to assume we have an asset that's worth $1 million, and it is subject to compounding appreciation of about 7% per year. We're going to assume that really just gets invested into capital growth and not into income. So we're going to look at gifting it away versus maybe keeping it until death, assuming that the gift and estate tax applicable credit don't apply and that the entire $1 million in value is subject to both the gift and the estate tax at a full 40% rate. Now, if you were to gift that away today, you'd have an additional gift tax of $400,000 if there was no applicable credit, which would ultimately reduce your estate by $1.4 million. As opposed to just $1 million. And not only that, if we assume 7% growth every year for both the asset and the gift tax that was removed from your estate, you're removing the growth and value on that base $1.4 million and not just $1 million every single year. So this compounding applies to both the gift amount and the amount of the gift taxes that were paid out of pocket. So essentially, we have a 40% estate tax savings on that gift tax of $160,000 because that $400,000 gift tax is removed from the gross estate. Now, there's a 3-year rule that applies here that a lot of people don't think of, and that 3-year rule doesn't pull into the gross estate any gifts made within 3 years of death, but it does pull back in any gift tax actually paid out of pocket within 3 years of death. So we'll look at the effect of that, but we're going to compare the year-over-year savings and the compounding that we might achieve by making a gift of this $1 million asset. So as you can see, with a 7% compounding, if we were to make this gift in 2021, these are going to be our results for years 2022 through 2031. So you can see that our estate tax savings continues to climb over here, and with that being said, we have a big jump from year 2024 to 2025, because that's the year at which we get out of the 3-year rule and we no longer have the risk of the gift tax that's paid out of pocket getting pulled back into the gross estate. So there's a lot of estate tax savings to be achieved here, especially when we look at the compounding and growth that could occur with respect to this $1 million gifted asset over this 10-year period. So ultimately, it looks like if we can get out to 2031, we've removed the potential for $1.1 million in estate tax. So that's an extra $1.1 million that'll be available to heirs. Now, we do have to net this out by the gift tax costs that we paid out of pocket up front. So when we look at that difference, we can see the difference is relatively small in the early years because of that 3-year rule applying. But once we get beyond the 3 years that follow the payment of gift tax out of pocket, we still have some pretty good results when we net out the gift tax that we paid, and we still end up with a net tax savings of $701,000 and change if we get out to year 10, which is $700,000 in additional assets that will go to the heirs. Now we have another benefit here that we can look at if we have this asset, instead of compounding, that maybe generates income. So if we have an income producing asset, we have one little loophole in the tax code that a lot of people don't recognize, and that's with respect to a grantor trust. Now, I've explained grantor trusts in a lot of previous episodes, but essentially, if you put an asset into a grantor trust, then you, the grantor, have a gift tax cost of putting that asset in, but the trust is ignored for income tax purposes, meaning that you're still treated as the owner of the asset for income tax purposes, even though you're treated as gifting it away for gift tax and for estate tax purposes. So, that income tax that you pay on behalf of the trust every year is removed from your estate, along with the actual income that stays in the trust. And not only does that income tax removed from your estate and the income removed from your estate, kind of reduce things, but it also compounds. And we're going to assume the same 7% compounding rate on the value of the income tax savings and income removal from your estate, while we're going to assume a base compound rate of 3% on the $1 million asset with an income rate of 5%. We have a smaller compound rate because that's offset by the higher income rate. I'm also going to assume here that when we ride the brackets up, we average out to an effective income tax rate, both state and federal, of 30%, and look at how this plays out. Now, this math may not be perfect, but this is kind of what I was able to do with a lot of modeling within Excel, that we can see that our compounded value of our gift, with the gift tax being removed from the estate, isn't quite as much as we saw with the previous example, but now that we have a grantor trust, we have to compound both the income that's removed from our estate because it's held in the trust, and also the income tax that we're paying on behalf of the trust, which is removed from our estate and notably is not subject to gift tax. So a big difference here is that if you pay the income tax of a donee who receives a gift directly, that is subject to gift tax. But if you pay the income tax of donees who receive assets indirectly through a grantor trust, you don't have to pay gift tax on that income tax that's being paid. So we can leverage that here, and we can see that the income that stays in the trust and the income tax that we pay really compounds over time to remove a lot from our estate. So we have a year-over-year analysis of what happens, looking at the total removed from our gross estate and then the estate tax savings that results at the time of our death. So we can see from an estate tax savings perspective, we have a much larger number at the end of the day. If we die in 2031, we ultimately add $1.3 million that can go to our heirs in terms of estate tax savings due to the tax inclusive nature of the estate tax. Now, if we were to focus on this number there, this 1.3 million, this looks great, but ultimately what we have to do is also net out the amount of taxes we actually paid during life. So in this case, we have to take into account the gift tax that was paid of $400,000 plus the income tax we've paid over time. Now, I didn't think about the compounding here, but ultimately I just took a straight difference between gift and income tax paid and an estate tax saved. And what we see is our results aren't quite as good as they were with just a straight gift. So a lot of that result is going to depend on the income tax rate that applies to that income. So with a lower income tax rate, you're going to have, less estate tax savings, but you're going to have greater net estate tax savings and vice versa. So all this exercise really kind of focuses on the fact that by combining the tax exclusive nature of the gift tax that you pay out of pocket with the payment of income tax on a grantor trust, you can reduce your gross estate by those amounts without paying additional gift tax. And that tax removed from your estate through the payment of lifetime taxes compounds over time, which can create additional estate tax savings that were unexpected, especially in the case of a grantor trust. So, even if the exclusion goes down, the sky is not falling. A gift to a grantor trust is still a great way to reduce the gross estate and the resulting estate tax liability. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.